Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Boom or bust versus a smooth equity curve. Some companies right now, especially in the AI space, are getting hammered, while a few are doing quite well. Are you tired of huge booms and busts in your portfolio and want a more stable equity return? Revere Asset's the most transparent advisor in the U.S., in my opinion, probably the whole world, and we put out a video every night the market's open, telling you what we're doing, telling you how the markets look. Now, we do very well during bear markets because we get defensive. We're not a pie charts or us. And even during corrections, classical definition of corrections, 10% or more, bear markets, 20% or more. Okay? However, in a sideways or channel or horizontal market, those are all the same technical terms for kind of when it goes sideways and gets choppy. It depends on the range. But we always protect the downside. And that's what we're going to discuss today. And very quickly, I'm going to read a quick mailbag from a long-term client who understands this. It's MB from July 24th. He said, "You are like the expert geologist with sensors in the ground looking for signs of an impending earthquake. As a retiree, that's why I can sleep well at night. Swan." And with that, let's go to, so I ask you, when you listen to these guys, do they sound like your advisor? Or does your advisor just want to go to lunch or go play golf or tennis? What's in your portfolio? Here's ours. Don?
Who the hell's going to play tennis with their clients, Dan?
Well, I used to because I hated golf.
How are your knees now?
My knees are actually very good. It's kind of shocking. A lot of tennis pros had.
All right,
we'll
start setting up some tennis matches with you, and we'll poll the clientele and see who can play. There's a lot of former tennis players out there that I know are. You have to have the right mindset to be a successful tennis player, and that applies to the markets as well. I see very often on Twitter people that are engaged in the markets have mention of tennis in their bio. But Dan, what you started out with is very valid. Let me read you a quote from Christian Flanders, who's a very successful trader and a great guy to follow on Twitter. He said, "I'd rather take the pain from following my rules than the pain from not following them."
Ooh.
And the reason he says that is because he has blown up in the past when he didn't follow his rules. He's also been very successful, and he's very aggressive from following his rules. But he understands the trade-off between the two. And, you mentioned choppy markets. Yeah, this is not a market for our approach to be successful in. But that quote, rather take the pain from following the rules than the pain from not following them. We couldn't look our clients in the eye if we let losses get away from us to the downside. And sometimes you have to sacrifice participation in the upside to do that. But what'll happen is the next bear market will come along. We'll lose a fraction of what would happen in a severe bear market. And net, that smooth equity curve would catch up to one that has massive peaks and valleys.
Right.
And we're kind of seeing that right now. We've also had on our thumbnail this week is, if you're not really engaged in trading, you won't know who the heck this guy is. But there's a guy named Leopold Aschenbrenner who worked for OpenAI. I didn't know this, but he was fired for OpenAI for supposedly leaking secrets. But he wrote a paper about the future of AI. He was given a bunch of money to open a hedge fund, even though he had zero trading experience. He levered up 4 times, made massive gains, And then overnight Wednesday was liquidated because the leverage caught up with him and he had no sell discipline.
Wow.
So that gets back to the pain of following my rules versus the pain of not following them. He had no rules. His plan was to ride AI to the moon with no thought that it could ever go wrong. And when you don't protect the downside, you get hit. He didn't just get hit with a 2x4 or a 4x4. I mean, that's like a Wile E. Coyote cliff breaking off and falling on your head. He's done. Basically he had to sell everything overnight to a large investment firm, Citadel Capital, in a fire sale. And he held on to some privately listed things like Anthropic, which hasn't come public yet, and he has big gains in. But he's begging people to put money back into his fund now. So
after he lost it all for him, the original principal.
Yeah. So this picture on the S&P 500 with this big shakeout candle on Wednesday into the close. Ironically, that was also right after the new Fed chair Warsh closed his press conference. There was brutal selling into the close. The next day, overnight, we gapped up. This line I'm highlighting is the 65-day exponential moving average. That's an orange line. That's where we broke out below. When I did the Tuesday video, I talked about this tight 4-day consolidation that we were in. We broke hard below that, reclaimed the 65 the next day. Overnight, Thursday into Friday, we actually got above the 50-day moving average, and we touched that intraday today before fading. So it's really casino-like action going on in the market. We don't play in the casino. We strive for the smooth equity curve. So we're down to one position in-house and our index position, which handles the rotation and the smoothness of the equity curve. We've got a very long list of stocks that we're watching. We're going to talk in the individual segments this week about what has held up the best that we're targeting and what has gotten destroyed and is an example of the boom or bust. And we're also going to talk about an issue with bonds in our segments that is of grave concern to the market, especially small caps. So I think I've summed that up pretty well. You can see really how tight outside of the breakdown on Wednesday and the reclaim on Friday, how tight we've been closing over the last 6-7 sessions. It's really just in a big tightening range for the S&P 500. Value stocks vastly outperforming growth stocks. AI, we hit minus 29% from the peak on our AI 100 index, and then it bounced 10% yesterday.
We didn't own those that you're tracking.
Yeah, we don't own them.
Yeah,
right.
We're not down 29%. Right. Okay, I just want to clarify that.
Yeah, the Revere AI 100 is our way of quantifying whether or not the bubble is actually bursting. And really that drawdown is within a normal distribution for how brutal those stocks move to the downside and the euphoria that they move to the upside. So it's not until that would be down 50 or 60% that you can kind of emphatically say that, yeah, that trade is over. That trade hurt. I've seen when I post this on Twitter, I've seen some people say, yeah, these stocks are cooked. The AI trade is over. We're not saying that. We're reporting the facts. You can decide what you take away from it. For us, it's, it just says stay away when they start acting like that. We'll stay away from, 75, 80% of them, but there are some that have held up quite well. And we'll talk about that throughout the segments today. So you have any questions before we move on, Dan?
Yeah, real quick. So I want to clean something up. Leading stocks on average fall 72% from the top. That was a study done by Bill O'Neill at IBD, right? So These growth stocks are not really meant to be held because you can lose too much, all right? Second thing is when Don said he's only got one position left, he's talking about the stock side. We've got 50% roughly in individual stocks, which has a lot of cash now, okay? And then we've got half that's in S&P, both cheap. Well, for the 200-day moving average and the 50-day moving average, they're very inexpensive S&P ETF so that it catches that sector rotation. The one on the 21 exponential, which means it's short term, that one he can use leveraged or whatever to dial up, push, hit the gas when it looks good, but also get defensive when it looks bad. So I just wanted to clarify, you don't have just one position. You've got a couple, right?
Yeah, it's in pieces that we manage, right?
yeah,
and for
yeah,
taxable
okay.
accounts, we hedge the gains for long-time
Taxable,
clients instead
right.
of initiating the taxable event. So yeah,
Right.
absolutely.
Okay. I just wanted to
All
clarify
right.
that so people understood our construction.
Okay, so let's start with Connor's segment first. He's going to talk about 3 stocks that did get destroyed during this AI sell-off. Then we're going to pivot to Ted, who's going to talk about 3 that held up very well. And then Todd is going to cover something that everybody that invests in stocks should be paying attention to, and that's bonds. So take it away, Connor.
Yep. Thanks, Don. Yeah, so just to touch, Don covered about the Leopold situation, really one of the craziest stories in the finance world. You probably won't hear about it if you're not, don't live, breathe the stock market like we do, but I'm going to talk about some of these names, and the volatility is just through the roof. Now, this is NVIS, and this has had from high to low a 51% pullback off the highs. And yesterday it was up 31% on the day. And again, that that is a huge move. But when you look at the chart, yesterday's candle just looks like a tiny little pop in a downtrend. And we're not going to call a bear market for AI stocks, but this is typically what you see is, in downtrends, you get those super, super big, fear sharp, one-day rallies. Maybe they can last a couple of days, but this was, perfect example. And plus you had the news of, part of the reason that some of these names are selling off so much was Leopold's fund was getting liquidated, right? He was running 4 times leverage on stocks that fell, 30 to 60% off the highs. And NVIS was one of his big holdings, and you can see it had that, big day yesterday. But again, today it's rejecting. And like Don said, there's too much volatility in these stocks. The fundamentals still look good, but that doesn't really matter when the chart looks like this. So really a lot of these names I'm going to cover, we're just observing them, we're watching them, waiting till they would fit our criteria. And pretty normal to see this fading after that big day yesterday. So that's NVIS. Another one is SanDisk. This is another one that, Leopold owned that got some of the, forced liquidation. And this one from high to low had a 57% pullback. And again, yesterday it was up, I want to say 25% on the day. But again, when you zoom out, it doesn't really look like anything on the chart, despite the big percent gain. And today it's rejecting, and it's, pulling back into 50% of yesterday's range as well. So this is what you're going to see with some of these names that are, beaten down off the highs. They're going to have these very sharp one-day rallies. But, when there's no setup and there's extreme volatility, we're just observing, waiting for them to set up and look more healthy. And then last one is Bloom Energy. This one was up a crazy 30% yesterday. And you can see it gapped up again today and rejecting and back near the lows of the day. And this is, I could give so many other examples of some of these AI names that are acting like this. And it's just extreme volatility right now. There's going to be big, one day moves up, moves down. But the bottom line, the summary is just we're observing these charts to, looks like they need a lot more time to base out. They could be topped. We don't know. That's always hindsight as well. So, just see if these can form new bases, have some tight price action, and just getting back above the 8 and 21 EMA would be a good start. So these, these are just,
yeah.
yes. So, just wanted to highlight some some big winners that are beaten down, that have seen some, strong bounces, but in the grand scheme of things, charts are still very broken.
Absolutely, for the most part. And hey, Connor, happy
Yep.
birthday.
Oh, thank you.
Oh,
It's Sunday, but it's close
it's
enough.
not today. I was going to say, should we all sing happy birthday to you don't want me to sing.
The ripe old
Todd's.
age of 25.
Oh my gosh.
25. And you know
Man.
what? Not just one birthday, Dan. We have to sing it twice because Todd's birthday is on Saturday. Todd not turning 25.
Yeah,
by the
he's
way.
not. You 57, Todd? What are you? A little more salt and pepper, right?
56.
56. Okay. Sorry about that. Didn't mean to add a year.
All right. All right. Let's so Connor talked about some just absolute brutal looking breakdowns here. Ted's going to pivot to three that have held up extraordinarily well. And we love to watch relative strength. So now really the question is, software has seen money flow into it as it has left other portions of the AI sectors over the last couple of weeks. Was that money just hiding out in software, or are these relative strength names something we should strongly consider if the market rights itself? Let's start off with the most beautiful base that's formed during this AI sell-off, and that's Snowflake. Take it away, Ted.
Done. During this recent pullback and chop of the last 2 months, it's very easy to pick out relative strength, and that's what we're constantly doing. One group in the markets that we've really kept our eye on is software and cyber together as a group. You could group cyber as a separate group, but for us in this segment, we're just going to call them all software stocks. The first one is Snowflake. This move started on an earnings gap where it gapped above the 200-day moving average, followed through a couple days, but then pulled back when the markets pulled back, and now built this cup with handle that it's breaking out of. And without even looking at price, if you just look at the relative strength line, it made a new high relative to the high made back in June. So instantly you can already tell that this is outperforming the S&P 500, and it's showing enormous relative strength to other stocks. If we then zoom in more, another key way of telling relative strength is what stocks are holding above key moving averages while indexes are breaking below. We know the S&P 500 and NASDAQ are below the 50-day moving average. They were recently below the 8 and 21. I'm not currently sure exactly where the S&P is because it's quite volatile, oscillating up and down above the 21, below the 21. But again, you can see SNOW is trending above the 21 for the last 5, 6, 7 weeks, while the S&P was living below it. So that's another key way of telling whether or not a stock is outperforming the S&P 500. And just another third way is stocks making new 52-week highs while the S&P or the general markets are in a pullback. And you can see SNOW, if you zoom out on a weekly chart, it just made a new 52-week high a couple days ago, and now it seems like we are confirming as of now. You can see above all key weekly moving averages, the relative strength line is making higher highs and higher lows. So it just looks fantastic. And you can look at the fundamentals too. Double-digit earnings growth and sales growth. So it has some favorable characteristics there as well. Another software stock is Datadog. Again, similar characteristics to SNOW for identifying relative strength. It's been holding the 50-day moving average and the 8 and 21, while the S&P 500 and NASDAQ broke below. You can see there's a relative strength blue dot. That's a market search indicator showing that a new high for the relative strength line has been put in while the stock is basing. So this is definitely a candidate that we're looking closely at. It's already owned in Turbo as well. But this continues to act beautifully. You can see the RS line is above that dotted line Don has on his chart. That is the 21 EMA for the RS line, not for the stock price. And we like to see that as well. We call this an RS phase when the relative strength line is above the 21 EMA for the RS line. So again, I think we might have made a new 52-week high today at the highs. It's hard to tell here, but if we did, that's another sign, like SNOW, that this is showing great relative strength as well. And to confirm that both of these gapped up around the same time above the 200-day moving averages on earnings. They're both in the software sector and group as well. So that just adds on to our conviction that these are acting well and show relative strength together. And then the third name is a cybersecurity name, CrowdStrike. And there are other cyber names acting well too, but we just chose this one for the segment instead of going over another 4 or 5 tickers. But again, CrowdStrike undercut reclaimed the 50-day moving average 3 times the past 3 days, not including today, while the S&P and NASDAQ have been below. And today, we reclaimed all key moving averages here. And you can see the relative strength line just got back above the 21 EMA as well. This is showing less relative strength to SNOW and DDOG for the reasons I just talked about before. RS line hasn't made a new high relative to the last few months. Price hasn't made a new 52-week high either. But relative to other stocks like Connor showed that are off 50, 60% off 52-week highs, this one is within striking distance of 52-week highs. So it doesn't have to be making a new 52-week high, even if it's within striking distance, 10 to 15%, while indexes have corrected 8 to 10, 12%. That's a stock showing relative strength because, as you know, growth stocks, the stocks we usually traffic in, they'll correct anywhere from 2 to 2.5 times the index. That's kind of what the AI infrastructure names have done. So those are 3 stocks showing relative strength in software. And on a more higher level macro, there's definitely chatter that the AI infrastructure stocks have run significantly in the last 3 years, and now the effects of these great AI models are being passed on to the applications. And we did have the software scare, but clearly the price action is showing that software is coming back, and a lot of these software companies, especially cybersecurity, are taking advantage of these new, really just world-class models from Claude and ChatGPT to boost their businesses, to refine their code. And cybersecurity companies especially have access to the best models because the government allows it to help just the entire United States and companies secure their code. And cybersecurity is just a huge part when data is a huge part of AI.
Right.
All right, good.
And that
good
RS
stuff.
is 96 still. That's pretty good. And those lines are starting to hook up. That's what you want to see. That's what you want to see. Sorry, Don, didn't mean to interrupt.
No, you're good. In mid-February of 2021, we wrapped up a huge run higher in small and mid speculative growth names. And one of the key reasons that came to an end was because there was a breakout in the 10-year yield at the time. And let's segue now over to Todd, and he's going to talk about bonds.
Yep. Sorry to discuss such a boring topic, but right now, the long end of the Treasury curve is under pressure right now, and it's a headwind potentially to equities, with the 30-year yield now climbing to 2007 levels. So we're the highest we've been since 2007 through 2004, approximately around 5.2%. This matters because, the long end of the curve is where investors express their views on long-term inflation. And the current move appears to be driven by sticky inflation expectation concern, as well as large deficits that the federal government's running. And the 10-year is really somewhat of the bellwether because that's considered the risk-free rate of return, whether you believe that or not. In the textbooks, that's considered the risk-free rate of return. And just to give you an idea, the 10-year, which we don't have a chart of the 10-year on Market Surge, but those yields have risen from 3.97% in February, and they're now 77 basis points higher to 4.74. And an interesting stat on this, for every 1 basis point increase in the 10-year yields or Treasury yields in general, that's almost a $4 billion increase in U.S. government debt service. So that increase in the 10-year alone results in almost 300 billion in extra interest charges to the US government. Okay. So that's on top of already exploding fiscal deficits. So this is definitely a concern. And on a final note with this has implications for equities because higher long-term rates raise the discount rate used to value future cash flows. Again, this is all somewhat theoretical, but true. Certainly, the higher you can get on risk-free rates and longer-term rates, the lower future cash flows are valued, and this can compress price earnings multiples, especially for growth stocks, which are considered long-duration assets. So this is something to pay close attention to. Doesn't mean we have to become extremely bearish or anything, but this is a headwind. And the first chart we're going to look at here is the 10-year. And if Don would pull up a monthly on that, we can see how this is potentially breaking out of a multi-year base here, going back several decades, back to the financial crisis. And let's just pull up the 30-year, which is the TYX, which all the 10, 20, and 30 are in very similar situations. And if we look at a monthly on that, or even a weekly on this for that matter, you can see it's just a massive breakout out of this long base that it's been in going back to 2024. And, just to add a little bit of potential insight on where this could go, Peter Brandt, who's a classical chartist and well-regarded, as a classical chartist, he says that the current breakout in the 10-year measures potentially up to over 7%. So whether that happens or not, we will see. But it appears right now the bond market is dictating Fed policy. The Fed did not raise rates in this last report. So the long end of the curve is growing, which potentially could cause the bond market vigilantes to price in higher rates as inflation expectations grow. So this is a lot of theoretical stuff, but it matters right now because of that potential discount rate on equity valuations, and that could be a potential tailwind as rates continue to rise here. So a very important item to keep watch of right now.
Yeah, let me put my Todd Terpeter on and kind of clean that up, because what he's saying is absolutely right. And why he's saying it puts pressure on small caps is because they need more financing and they borrow more and need to borrow more and are more risky than the large cap companies. So when rates rise, this is an interest rate chart, not a chart of the bonds. Interest rates and bond prices move inversely, right? So and it also puts a damper on the economy because it also costs large companies or mid-size, anybody that's financing money, right? It causes them to pay more. And so that can slow the economy, number one. And number two, it's really hard on the small and more speculative names. And that's what he's saying in plain English.
Yeah.
All right, go ahead, Don.
Growth stocks, mortgage rates as well. Mortgage rates.
Right. Borrowing. Yep. Mm-hmm. Right. Go ahead, Don.
Yeah, and here's the TLT. As Dan mentioned, bond prices move opposite of yield. So breakout in the 10-year yield, you're going to see a breakdown in the price of TLT. And that's what this chart is showing. All right, let's go back to the S&P 500 very quickly. We're up slightly back in between the flat 65-day exponential moving average and also the flat 50-day moving average. So back inside that consolidation, attempt to break out at the open today failed. Attempt to break down Wednesday also failed. So we'll wait for some more clues to come from the market. Let's quickly look at the NASDAQ 100. And that's also looking like a failed breakdown below the 100-day moving average. rallied up today into the declining 65-day moving average before reversing. So also in a bigger range, but much choppier. Will not close. There's two more I want to show. This is the equal weight S&P 500, which while growth was pulling back strongly, outperformed. This is the relative strength line highlighted in blue as these were pulling back, as the growth stocks were pulling back because of the heavy capital, the heavy weights in the market cap weighted S&P 500, the equal cap weighted outperformed as money rotated into value. And let's quickly look at the Russell 2000 small caps, which are the worst performing index on the day today. You can see the 21-day exponential moving average, that's the green line, is acting as resistance to that. It's been battling back and forth around the 50-day moving average, finding support at the 65-day exponential moving average. And notice the relative strength line of small caps breaking below its 21-day moving average today as well. Those are all things we're keeping an eye on, and we update them every night in our videos. Dan, that's it from the tech side. You can go ahead and take us on home.
Well, that's great, Don. So I started the show saying boom or bust versus a smooth equity curve. So are we is this the beginning of the another tech wreck with the AI stocks? Or are we going to resume the rally? We have no idea. That's why we watch this every day. Price is truth. Price and volume is truth. No exceptions, period. Listen, does your advisor sound like this? If you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button, and we'll send you our daily market insight videos every day the market's open, and including this podcast that will come out Saturday morning. However, if you go to YouTube and just search for Revere Asset and hit subscribe, Zach, our producer, will have this show out within an hour or two. It's 11:15 Central Time. He'll have it out by 1. That's where the active people get theirs. And we also put more stuff on the weekends out on YouTube that we don't send out via our newsletter. So there's two ways to get our content. Now, you can also go to the button next door on our website, Contact Us, and you can send us an email if you want a complimentary portfolio review, or want to become a client, or have any questions, or want a stock discussed on the show. And you can always call us at 855-REAL-WEALTH, old school. We'll talk to you next week on Your Money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.